Welcome to Chapter 9 of the Wealth Management Essentials course. In this chapter, we'll be talking about tax reduction strategies. There are 4 different learning objectives in this chapter. We'll be touching on techniques to minimize taxes, the tax-free savings account, registered plans used for non-retirement goals, and incorporation. So first, we'll look at some techniques to minimize tax. So there are quite a few different ways to do this, but one of the main one is income splitting, except where restricted from attribution rules. And so the attribution rules require that certain forms of income from a transfer be taxed in the hands of the transferor and not in those of the recipient. So it applies to income in the form of interest, dividends, and capital gains. For example, a transfer or loan of funds or property by an individual to a spouse or a minor child who uses the funds or property to earn investment income. That would be a situation where the attribution rules would come into play. There is, however, an exemption if funds are lent out and that you are charging an interest at prevailing prescribed rates. So if you are lending out money to someone and you do, if they are paying you an interest rate according to the prescribed rate, then it doesn't fall into the attribution rule. And so I do have a list of some different attribution rules here. So if you are gifting to a spouse, then the investment income or losses and capital gains, they are attributed to the giver. If you are gifting funds to a child, sibling, niece, or nephew, just a minor under the age of 18, then the investment income or losses, they're attributed to the giver as well. And to a child over 18, there is no attribution that occurs. So it's only for a minor under 18 or to a spouse where the giver would have to claim the income. Now, if you do sell an asset, the sale must be made at a fair market value, and the spouse must elect a spousal rollover. Otherwise, the investment income would be attributed to the seller. And so that comes into play for both the spouse and child under the age of 18. So if you don't sell the asset for fair market value, then some gains would be attributed to the seller. That might come into play for a property or a cottage. If you're selling it to a family member, then it could potentially cause some attribution rules. If you are selling to a child over the age of 18, there aren't any attribution rules. For a loan, the loan must bear an interest at the prescribed rate. Otherwise, the income would be attributed to the lender. So that's for a spouse and a minor. If you do have a child over the 18 and you're giving them a loan, then it is mainly used to reduce or avoid income tax. And so if you are providing a loan to a child over the age of 18, the same sort of thing, but if the loan does bear an interest rate at the prescribed rate, then no attribution occurs. And just to reinforce the attribution rules, the only way to split income with a child is to loan it to them at a prescribed rate. The child must be turning 18 that year. If the child is a minor, you can set up a formal trust with the minor children as beneficiaries. You can loan the money to the trust. Clients can split their income with their children if they give or lend them cash to invest. And they can transfer existing investments to their children, but it is a deemed disposition, so they would have to trigger any gains if there are any. And splitting income with children. So this is another topic that could come up. Clients cannot legally split investment income with a child under the age of 18. There are ways for clients to pass assets to minor children and have the capital gains attributed to them, but you can't actually split the current investment income. Children who are 18 or older can have investment income attributed to them since they are eligible to set up their own accounts. However, it is important to think about the legal form of the transaction because basically you're giving assets to the children and then it's technically theirs. So you do have to consider that legal aspect about that. Inter vivos trusts allow clients to maintain control of assets while attributing the income to the trust's beneficiaries, which is usually children. So that's another way to split investment income with children. Now, in terms of splitting retirement income, usually you do that with a spouse. Spousal RSPs, that's a good way to do it. It allows income to be attributed to a spouse in retirement. So a husband could set up a spousal RSP for a wife. They would get the income tax deduction when putting it in the spousal RSP, and then say in retirement, the wife takes it out and it comes out under their tax return. Pension income splitting allows clients to split up to half of their pension income with their spouse. Pension income either comes from a registered pension plan or a RIF and LIF. So you do have to be at least age 65 to have income from a RIF and LIF be considered pension income. But if you are that age, it is definitely worth converting your RSP to a RIF and taking money out that way, just because it gives the accountant the option to split it with your spouse. Also, CPP can be shared. That's something that needs to be applied for with CRA before you start taking it. Another concept is paying salary or profits to family members, especially if you're a sole proprietor. So they can pay a salary to a spouse in exchange for services, but the salary would be treated as a deductible for the business, so that's good, and income for the spouse. But it sort of does need to be in exchange for services. And the same can be done with any family member. Next, we'll look at transferring a capital loss to a spouse. So say Paul sells shares on the open market and triggers a $15,000 capital loss. The wife then buys the same number of shares immediately or within 30 days after Paul sells the shares. And this has two results. So Paul's $15,000 capital loss is denied because the superficial loss rule imposes a 30-day time limit on repurchases. And the second result of Paul's sale is that the wife will pay just $5,000 for her shares, but the $15,000 loss is denied to Paul, and it is added to her cost. So the loss provides her with an adjusted cost base of $20,000. Paul's loss is handed to Esther, the wife, in the form of a higher adjusted cost base, so that she can then have a lower capital gain or a greater capital loss when she ultimately sells the shares. So then the wife would have to wait at least 30 days to just get out of that 30-day superficial loss window before she sells the shares, just so that she can claim that capital loss. So it is possible to transfer a capital loss to a spouse. Basically, you just need to sell those shares to the spouse, and then they can buy it for that higher adjusted cost base, and then they could sell it on the open market 30 days later and claim that capital loss. Next, we'll look at transferring personal tax credits. So the remaining unused credits, they can be passed to a spouse. So one is the age credit. So if a spouse was 65 years or older in the year and they don't use that credit, it can be passed on. Same with the disability tax credit, pension credit, and tuition credit. There are some other tax savings. So you can avoid borrowing for consumption, instead borrow to invest. So the interest is deductible. So what that means is instead of borrowing to buy a car, instead you use money from your non-registered account, buy the car outright, and borrow to invest in the non-registered account. Overall, it's basically the same thing. You have the car, you have a loan, and you have the same amount in your non-registered. It's just that technically the loan is now for the non-registered, therefore you can deduct the interest expense. So it is just a way to save on some taxes. Also reporting dividends on the lower income spouse's tax return, so that does help on some taxes. Tax loss selling. So this is when you realize the capital losses at the end of the calendar year to offset gains. So sometimes you might want to sell something that has a capital loss right before the end of the year, so that you can save on the taxes that you'd have to pay in the spring. There is some debate around that. If the investment is something you don't think you'll end up wanting, then it does make sense to at least do it before the end of the year rather than in January. Using permanent insurance as a tax shelter, there's a lot of different permanent insurance policy concepts that can really help, especially if someone has a corporation. There's estate bond concepts and things like that can really shelter a lot of that money into the insurance policy. The insurance policy grows tax-free. And then you can either borrow against the policy or ideally leave it to your estate. So when you pass away, insurance is tax-free. And it's just a way to avoid a lot of tax on the growth of that money, especially if your tax-free savings accounts are maximized. The lifetime capital gains exemption. So that mainly is important for self-employed business owners. Sometimes rather than selling the actual assets of their business, they'll sell the shares of the business. And if it's a small business, it can qualify for that lifetime capital gains exemption, and they might not have to pay any tax on that sale. Charitable donation tax credits. So if you do donate to registered charities, you do get a tax credit for that. And then there's the $1,000 rule. So if personal use property is sold for more than $1,000, then capital gains are supposed to be claimed, and a capital loss can be claimed for listed personal property like works of art, jewelry, books, stamps, and coin collections. So that's sort of just a rule. I mean, if you were to sell something for $1,000, maybe you'd sell it for $990 instead. And then, of course, you have the principal residence exemption. So if you do sell your principal residence, your home, then you don't have to pay any tax. And then you have Labor-Sponsored Venture Capital Corporation, LSVCC. So these are basically a fund that you could buy. They're basically called labor-sponsored funds. You're buying into usually fairly local companies, maybe Canadian companies, and it does help you on your taxes. They aren't really used too much anymore because sometimes they don't turn out to actually benefiting you, but there was some merit to them at least a while ago. Next, we'll touch on the TFSA. So you do start accumulating TFSA room at age 18. You'd have to wait until age of majority to open it. Depending on your province, it's either 18 or 19. The maximum room is 88,000 as of 2023. So obviously, if you open a TFSA, you don't get a deduction for putting money in it. But all the money and growth in the TFSA is never taxed, not even if you pass away. And you do accumulate a little bit more room each year, but it is a tax shelter, so there is a limit on it. 2024, you'll get another $7,000 of contribution room, so the maximum room would be $95,000 for someone who was 18 at least at 2009. And as I mentioned, you do accumulate more room each year. Tax-free on withdrawal, growth, and estate if you were to pass away. If you do go over your contribution limit, then there is a penalty. So you would have to pay 1% per month in penalties. So it is really important to stay under that limit. So for example, if you were turning 18 this year, 2023, well, you'd only have $6,500 of room because that was the contribution room you gained this year. Next year, you'd get another $7,000, and you just start accumulating more room each year. There's also the RESP, so this can be helpful to save on some taxes and just really helpful in general for saving for children's education. So you have a max lifetime contribution of $50,000. The government provides the grant portion of at least 20% on the first $2,500 per child per year. So if you do put $2,500 in, the government gives you $500 of grant. It is not tax deductible. So basically, you are using after-tax dollars to contribute to the RESP, but the growth is tax deferred, and it's actually taxed on the beneficiary, the child, when it does come out. So it is a way to grow some investments and get the grant portion in this account, and then when it comes out, only the growth and the grant portion is taxed, but it's taxed on the child's tax return, which is usually quite beneficial because they're paying a much lower tax rate than you would generally. Your lifetime grant, the maximum lifetime grant is $7,200 per beneficiary. You can actually catch up on unused room in prior years. It can only be 1 year at a time. So if you started the RESP late, then you could put $5,000 in per child until you catch up on all your room. When the child does go to post-secondary education, they can withdraw the grant portion from the RESP. If they didn't go back, they would lose the grant portion, but they would keep the principal and the growth, just that the growth would be taxable. There's also the RDSP. So this is an account that isn't used as much, but a beneficiary qualifies for the RDSP if they have the disability tax credit. And so contributions can only be made in this account until the end of the year the beneficiary turns 59, but matching grants are only eligible until the beneficiary is 49 years old. And so the grants on the bottom, you can see the Canada Disability Savings Grant. So it matches contributions on a sliding scale depending on the family net income and amount contributed. The total potential grant is $3,500 annually with a lifetime limit of $70,000. And then there's the Canada Disability Savings Bond. So the potential limit for that is $1,000 annually and $20,000 over the beneficiary's lifetime. So as a minimum, if you are making a ton of money and you aren't going to qualify for any of these additional grants, someone with the disability tax credits, they could at least put $1,000 in. The government would match that $1,000. Quite often, they'll add a lot more. There have been cases where maybe the person puts, let's say, $10,000 in over a number of years, and the government gives them $20,000 or $30,000 of grants. So the RDSP is definitely something to look into if you qualify. The grant must stay in the plan for at least 10 years to avoid the penalties. So the RDSP is mainly for retirement for that person with the disability tax credit. If the RDSP has more grant and bond money than contributions in the plan, which usually is the case, then a maximum of 10% of the lifetime disability assessment payment can be withdrawn. So there are some restrictions when withdrawing from the account normally. Next, we'll look at Deferred Profit Sharing Plan, DPSP. So it is a trust set up by a company to offer all or certain employees a pension plan that pays out some of the company profits. An employer makes cash distributions to the DPSP from business profits, and employees do not contribute to it. So it is just a benefit for employees. You get some of that company profit, and it does give the employees a bit more incentive even. It can contribute a maximum of the lesser of 18% of the annual salary, or $15,390, which does increase each year, and it does use the employee's RSP contribution room. Withdrawals from the DPSP are taxable since it does you do get that deduction because of the RSP contribution room. So now briefly just talking about incorporation. So small business owners can incorporate, which can provide tax benefits. So a CCPC, which is a Canadian Controlled Private Corporation, it is eligible for the lifetime capital gains exemption of just over $900,000 as of 2023. And if the business appreciates in value and the owner sells the business, they can use that to avoid paying some or all of the capital gains tax. So quite often small business owners, they will look to sell the actual shares of the business, of their incorporated company that owns the business. And the reason they do that is because then they're eligible for the lifetime capital gains exemption, and they can avoid paying the tax on the growth of the business. A CCPC is taxed at the following rates. So if that business is making income up to $500,000, they're taxed at 9% on that if they leave the money in the company. Anything above the $500,000 is taxed at 15%. And the 2018 federal budget did make some changes. So for corporations that are earning passive income, usually from investments, so a company can set up an investment account and earn income from that because it's sort of like a non-registered corporate account. Well, the first $50,000 of passive income, it's not affected, but passive income between $50,000 and $150,000 will reduce the access to limit by $5 for every $1. Essentially, if a business earns, let's say, $120,000 of passive income, then their limit, that $500,000, it's reduced by 70,000 times 5, so 350. So then income made above 150 is taxed at 15% in this case. So it definitely is something to watch out for, is to make sure that your company isn't making too much passive income, because then it will cause you to pay more taxes on the income left in the company. There are some non-tax benefits of incorporating. One is limited liability. So if you own the business personally and the business gets sued, well, then you are personally liable. If you own it inside an incorporated company, a corporation, well, then the business or the corporation has the liability, not yourself. So it does protect you from that. And also for estate planning, so the corporation, it is its own legal entity, and it remains intact when the owner passes away. So what happens is, if you own shares of a company and you pass away, well, the shares of your company just go to your spouse or whoever you deem in your will. There are some cons. It is quite costly to set up, and usually you'd have to have a tax return done each year. So there are some accounting fees. It can complicate a situation. In personal service businesses, they do not benefit from the preferred corporate tax rates. It is complex to define, but generally the PSB rules target incorporated entities who would otherwise consider individual employees. So an example occurs when an employee leaves the company and then incorporates, and the former employer then hires the newly incorporated company to perform the same work the previous employee did. So the government realizes it's a bit of a loophole, and so they have some rules around that. And so those are all the main concepts of Chapter 9. I really hope you found this review helpful, and I'll see you all in Chapter 10.